In the annals of business history, some ideas emerge with such compelling narratives, such magnetic founders, that they seem impervious to doubt.
These aren't just good ideas, they are perfect stories, meticulously crafted to resonate with our desires for innovation, community, and disruption.
But what if this perfection itself is the greatest danger? What if the moment an idea feels too good to challenge, too grand to question, is precisely the moment we should run?
This deep dive investigates how these seemingly unimpeachable visions can become the most expensive lies, leaving a trail of vanished billions and shattered trust. We begin with a prime example, WeWork. At the heart of many such ventures stands a figure of almost mythic charisma. For WeWork, that figure was Adam Neumann. His vision transcended mere office rentals, promising a global community, a lifestyle, a movement.
Reports from former employees and investors consistently described Neumann as a captivating orator, capable of inspiring fervent loyalty and belief.
This magnetic personality wasn't just a bonus, it was integral to the company's pitch, transforming a conventional real estate business into a tech company poised to revolutionize how we work and live. This powerful personal brand often overshadowed the underlying business realities, deflecting scrutiny with sheer force of personality.
WeWork wasn't selling desks, it was selling belonging.
Its narrative was an intoxicating blend of innovation, purpose, and community, designed to appeal to a generation yearning for meaning in their work.
WeWork is not a real estate company, it's a state of being, Neumann famously declared.
This grand narrative was meticulously woven into every aspect of its branding, from its sleek office designs to its mission-driven rhetoric. Financial analysts often struggled to categorize it, leading to debates over whether it was a tech platform, a hospitality provider, or simply a landlord. The ambiguity, paradoxically, strengthened its appeal, allowing it to claim the disruptive potential of Silicon Valley while operating with traditional real estate economics. The power of this narrative translated directly into an astonishing financial valuation. Investors, particularly SoftBank and its Vision Fund, poured billions into WeWork, propelling its private market valuation to an eye-watering $47 billion in January 2019. This figure placed it among the most valuable startups globally, despite consistent losses and a business model that, at its core, leased properties and subleased desks. According to financial disclosures, the company never posted a profit as a private entity. The valuation seemed less tethered to traditional financial metrics and more to the captivating story and the fear of missing out among investors desperate to back the next big thing.
How did sophisticated investors, known for their rigorous due diligence, overlook fundamental weaknesses? Financial analysts frequently pointed to WeWork's ballooning losses and its questionable accounting practices.
For instance, the company's adjusted EBITDA metrics, which excluded significant expenses, were widely criticized for painting an overly optimistic picture. Yet, these red flags were often dismissed under the sway of Neumann's vision and the perceived scarcity of such transformative opportunities. The allure of being part of something bigger than real estate created a significant blind spot, where traditional financial prudence was sacrificed for the promise of exponential growth and societal impact.
Masayoshi Son, CEO of SoftBank and orchestrator of the Vision Fund, was perhaps WeWork's most ardent believer.
He saw Neumann as a visionary akin to himself, ready to reshape the world. According to reports from the Wall Street Journal, Son, after a brief meeting with Neumann, decided to invest billions, saying, "Adam, in 10 years, you'll be bigger than WeWork." This profound conviction, born from a belief in the founder's ambition rather than meticulous financial analysis, underscored the narrative's power. It became a self-fulfilling prophecy of sorts, where the sheer volume of investment validated the story, making it even harder for others to question, creating a cycle of escalating belief and capital deployment.
The core conflict at WeWork lay in the stark contrast between its lofty vision and its prosaic operational reality.
On the one hand, a self-proclaimed space-as-a-service technology platform that aimed to elevate human consciousness. On the other, a company that signed long-term leases and offered short-term subleases, essentially a real estate arbitrage model with significant capital expenditure. This disparity meant that while the company spoke of network effects and proprietary technology, its balance sheet was dominated by lease liabilities and property management costs. The perfect story allowed it to command a tech valuation, while its underlying business structure was more akin to a highly leveraged landlord, subject to the cyclical nature of the commercial real estate market. The billions flowing into WeWork enabled an aggressive, almost frenetic global expansion. Financial filings revealed that between 2010 and 2018, WeWork expanded to over 400 locations in 27 countries, securing a dominant position in co-working spaces. This rapid growth, while impressive on paper, was fueled by debt and equity infusions, not organic profitability. According to regulatory filings from 2019, the company lost approximately $1.9 billion on revenues of $1.8 billion in 2018 alone. This spending strategy was justified by the belief that scale would eventually lead to profitability, a common mantra in the tech world. However, for a real estate business, such a strategy merely amplifies losses without a clear path to sustainable returns. The combination of a powerful narrative, a charismatic founder, and vast sums of capital created an environment where internal dissent was actively discouraged or simply drowned out.
Employees, eager to be part of a mission-driven company, often overlooked or rationalized questionable practices.
Investors, having committed significant funds, had a vested interest in maintaining the positive narrative, lest their own positions be devalued. This silencing effect meant that fundamental questions about profitability, corporate governance, and sustainable growth were rarely, if ever, asked with the necessary rigor. The cult of personality surrounding Newman made it challenging for even seasoned board members to challenge his decisions effectively. Beyond the financial metrics, numerous corporate governance red flags emerged well before WeWork's attempted IPO.
Reports from Reuters and other financial news outlets detailed how Adam Neumann personally leased properties to WeWork, effectively becoming his company's landlord.
He also held significant control through supervoting shares, reducing accountability to other stakeholders. Furthermore, Neumann received a $5.9 million payment for trademarking the word "we" and allowing the company to use it, a transaction that drew widespread criticism. These arrangements, blatant conflicts of interest, were often rationalized as part of a visionary approach, rather than being treated as serious governance breaches.
This pattern illustrates how a powerful story can obfuscate clear ethical boundaries.
The list of corporate governance issues at WeWork was extensive and highly concerning. A key problem was the lack of independent oversight, with a board often perceived as deferential to Neumann. The company's original S-1 filing, a mandatory disclosure for IPOs, revealed a staggering number of related party transactions and questionable financial dealings. Critics, including analysts from Institutional Shareholder Services, highlighted the unusual share structure that gave Neumann unprecedented control, even post-IPO. Such structures, while not unique, are often seen as detrimental to shareholder value and good corporate practice. These issues, once public, became a major stumbling block for the planned IPO, demonstrating the market's ultimate intolerance for such practices. The moment of truth arrived with the preparation for WeWork's initial public offering in 2019. The scrutiny of public market investors and regulators proved far more rigorous than that of private venture capitalists.
The S-1 filing, intended to showcase the company's strengths, instead exposed its deep vulnerabilities.
Analysts, freed from the charismatic spell, dissected the financials, governance issues, and the sheer scale of the losses.
The market's reaction was swift and brutal.
Initial valuation estimates plummeted from $47 billion to as low as $10 to $15 billion, and eventually, the IPO was pulled entirely. This public examination laid bare the truth: a compelling story could not withstand the harsh light of fundamental financial analysis.
Following the failed IPO attempt and Adam Neumann's ousting, WeWork's valuation collapsed dramatically. SoftBank was forced to launch a massive bailout package to keep the company afloat, effectively nationalizing the distressed venture.
The reported losses continued to mount, reaching billions annually. According to reports by Bloomberg, SoftBank injected over $10 billion into WeWork post-IPO attempt, drastically reducing its own funds' returns. This catastrophic fall from grace illustrated the profound disconnect between the private market's exuberant valuations and the public market's demand for clear, sustainable profitability. It also highlighted the immense cost of unchecked ambition and a narrative that prioritized vision over viability, leaving a trail of significant investor losses. WeWork's story is not an isolated incident, it's a template for how compelling narratives can become financial traps. The pattern is strikingly consistent: a charismatic founder, a disruptive vision that transcends industry norms, a rush of early investment that validates the narrative, and a culture that actively suppresses dissent. These elements combine to create an echo chamber where fundamental questions are silenced, and perceived potential outweighs tangible performance. The trap lies in the human tendency to believe in a good story, especially when it promises to change the world, even when the numbers whisper a different truth. It's a powerful lesson in the psychology of investment and the pitfalls of unchecked enthusiasm. Several well-documented behavioral biases contribute to the allure and eventual collapse of such ventures. Confirmation bias leads investors to seek out and interpret information that confirms their initial belief in the perfect story, while ignoring contradictory evidence. Herd mentality drives others to follow leading investors, assuming they possess superior insight, rather than conducting their own independent analysis. Overconfidence, particularly in founders and early investors, can lead to underestimating risks and overestimating potential returns. These cognitive shortcuts, deeply ingrained in human psychology, make us vulnerable to narratives that bypass rational assessment in favor of emotional appeal and the promise of extraordinary returns. The greatest danger often emerges when an idea feels unassailable, when the conviction in its success becomes absolute. As financial historian Charles Kindleberger noted in his work on financial crises, there is nothing so disturbing to one's well-being and judgment as to see a friend get rich. This sentiment captures the competitive pressure and envy that can cloud judgment, turning initial skepticism into reluctant belief. When a venture capital firm with a stellar track record invests, others assume they must know something. This perceived certainty, however, is frequently a mirage, obscuring the critical questions that would otherwise protect investors from unsustainable ventures. The loudest shouts of certainty can often hide the deepest flaws. So, how can investors and observers protect themselves from such traps? The first step is to cultivate a relentless skepticism, especially when confronted with a narrative that seems too perfect. Look beyond the vision and scrutinize the fundamentals, the business model, unit economics, and path to profitability. Pay close attention to corporate governance. Is there proper oversight and accountability? Be wary of companies that demand constant infusions of capital without demonstrating sustainable revenue. Question the tech label if the core operations resemble a traditional industry. And critically, challenge charismatic founders by demanding data, not just anecdotes. These flags, once learned, can be the difference between prudent investment and significant loss. The cost of these convincing business ideas extends far beyond the billions in vanished capital. It erodes trust in innovation, dampens future investment in legitimate disruptors, and can lead to widespread job losses when these ventures inevitably falter. The WeWork saga, alongside others like Theranos, serves as a stark reminder that belief, when unchecked by rigorous analysis, can be a dangerous luxury. The ecosystem of venture capital and startups thrives on optimism, but a healthy dose of skepticism is essential to filter out the unsustainable fantasies from the genuine breakthroughs. Ultimately, the market punishes those who confuse compelling storytelling with sound business strategy. The enduring lesson from WeWork and similar stories is simple yet profound: the most convincing ideas are often the biggest traps because their perfection discourages the very questions necessary for survival. True innovation doesn't fear scrutiny, it thrives on it. It invites challenges, adapts to feedback, and proves its worth through tangible results, not just captivating narratives. As investors, entrepreneurs, or simply observers of the business world, our greatest defense against these seductive illusions is an unwavering commitment to critical thinking. When something feels too good to be true, or too grand to challenge, that's your cue to dig deeper, to question harder, and to seek the uncomfortable truth beneath the perfect story. The allure of a perfect business idea, backed by a magnetic founder and a narrative of world-changing disruption, can be intoxicating.
But as we've seen with WeWork, this very allure can become a veil, obscuring fundamental flaws until it's too late.
The next time a business proposition feels impossible to doubt, take a moment.
Challenge the narrative. Scrutinize the numbers. Because in the world of high finance and grand visions, the best story is often the most expensive lie. What are your thoughts on how we can better identify these traps? Share your insights in the comments below. And if this deep dive sparked your critical thinking, please like and subscribe for more investigative analysis into the world of business and economics.